All right, let's get right into today's institutional market breakdown. We're looking at gold, or XAUUSD, and we are focusing entirely on order flow and smart money concepts. Look, this isn't about guessing where the market might go. It's about reading the actual footprints of major financial institutions and aligning our positioning with theirs. Let's look at the data objectively.
Okay, let's dive into this. Gold is currently approaching a massive liquidity zone, and smart money is already positioning ahead of the next expansion move. What we've just witnessed is a textbook sell-side liquidity sweep. Retail traders typically look at this as a breakdown, right? But institutional players see it for what it really is, a prime opportunity to accumulate at a deep discount. They're essentially engineering liquidity, driving prices lower to trigger retail stop losses, which then provides them with the massive volume they need to fill their own orders without causing an immediate price spike.
To truly grasp the order flow, we have to understand the macroeconomic environment that's actually driving it. Recent reports show that Iran has halted indirect talks with the US. On top of that, they're developing plans from the resistance front to blockade the Strait of Hormuz and the Bab el-Mandeb Strait. These are absolutely critical global supply choke points. Naturally, this sudden spike in geopolitical risk is driving a very strong safe haven flow straight into the US dollar. However, the market is currently compressing. It's holding its breath for a major volatility catalyst, the US JOLTS job openings data, dropping precisely at 9 p.m.
Now, what's really interesting about this slide is how the economic calendar essentially dictates institutional timing. If you look at the schedule alongside the JOLTS data, we also have key FOMC members speaking. Institutions are holding the market in a very tight, controlled range ahead of these events. They are perfectly content to just sit back and let retail traders chop themselves up in these low-probability environments while they wait for the massive liquidity injection that high-impact news provides. To them, the news isn't just data, it's literally the mechanism they use to drive price directly into their predetermined target zones.
Let's transition over to our multi-timeframe market structure analysis to identify exactly where the dominant money is flowing.
Starting with the 4-hour chart, the dominant structure is undeniably bearish. Notice the clear, methodical sequence of lower highs and lower lows cascading all the way from the 4580 to 4600 region. More importantly, observe how the price is being heavily suppressed right below both the 50-period and 100-period exponential moving averages. Any upward movement we're seeing here is currently just a correction, a temporary retracement within a much larger bearish paradigm. Make no mistake, heavy institutional sellers are still very much in control of this macro timeframe.
Let's move to and see how this builds on the 1-hour time frame. Look closely at the bottom of the structure here. We're seeing long lower wicks forming right at that 4460 to 4470 level. This is a crucial footprint. It proves there was a deliberate sweep of sell-side liquidity. Market makers pushed the price down into that double bottom area specifically to clear out early buyers. And the immediate rejection, those long wicks, tells us strong institutional demand stepped in to absorb all that selling pressure.
Dropping down to our execution time frame, the 15-minute chart, you'll see the microstructure is shifting. We have a confirmed bullish change of character, or CHOCH, as price broke right above the short-term high at 4490. Furthermore, price just crossed back above the M15 EMA 50. What's absolutely vital to note here is the volume. We are seeing low volume accumulation at the lows. Market makers are quietly gathering positions without showing their full hand, setting the stage for a short-term bullish expansion before that heavier H4 bearish trend potentially resumes.
Let's look at the institutional trading plan, specifically our smart money setups based on these pre-calculated levels. Here are the precise mathematical parameters for today's session. Scenario 1. Our primary intraday buy setup targets an entry right between 4485 and 4490. We're placing a hard stop loss at 4473 with a take profit mapped out at 4520. That yields a solid 1 to 2.3 risk to reward ratio. Scenario 2, which is our broader trend sell setup, looks for an entry much higher, up in the 4520 to 4525 zone. The stop loss there is strictly placed at 4536, targeting a full move back down to 4470. That alternative offers a highly asymmetric 1 to 3.3 risk to reward.
So the crucial point is the underlying institutional logic for these exact levels. For the buy scenario, we're looking to capitalize on a short-term mitigation of a discount zone. We are waiting specifically for a retest of the M15 EMA 50 where we know smart money was accumulating. Conversely, the sell scenario is explicitly designed to fade a retail breakout. We fully anticipate market makers will push the price up to 4520 simply to sweep that buy-side liquidity,
triggering the stop losses of early short sellers right into the heavy resistance of the H1 EMA 50 before driving the market lower again.
Moving on to our trade execution and invalidation logic, because professional traders wait for confirmation. And this brilliantly illustrates the disciplined step-by-step procedure required to safely execute this plan. Step 1, you wait patiently for the M15 to retest the 44.85 to 44.90 zone. Do not front-run the order flow. Step 2, do not enter until you actually see confirmation, like a strong bullish engulfing candle, proving that institutional buyers are aggressively defending that exact level. Step 3, and this is completely non-negotiable, manage your risk, or close the position entirely before that 9 p.m. JOLTS data hits. Holding unhedged positions through major news events is gambling, it's not trading, and the risk of severe slippage is just too high.
Now, equally important is knowing exactly when a trade thesis is wrong. If the M15 chart closes with a solid body below 44.75, our short-term bullish hypothesis is immediately invalidated. Period. The buy setup is canceled. Similarly, if the H1 chart manages a solid body close above 45.40, that heavy macro bearish bias is compromised, which cleanly invalidates the sell setup. We rely on strict invalidation parameters to protect capital. There's simply no room for hope or emotion in institutional execution.
Understanding these smart money concepts gives you a clear, objective framework to navigate the markets, rather than just reacting emotionally to the constant retail noise. If you want more of this institutional-style market analysis using SMC and ICT methodology, make sure you subscribe to our Explainer series. And if you want to follow future trading opportunities and execute on these detailed breakdowns, you can open your trading account right now using the link in the pinned comment. The ultimate question you have to ask yourself is, will you align your execution with the institutional order flow, or will you just continue to be the liquidity they hunt?